Okay, guys, welcome to today's video, and we'll be talking about something very important, right? Liquidity grab versus liquidity run, right? So that you guys can understand the term and how to basically use it or support it, right? So I'll just be differentiating it real quick. So the major difference between the two is one is basically for reversals and one is basically for continuations. Remember, right, our basic SMC is all about liquidity, right? Liquidity is the fuel that what makes a move. It means before price takes a move is rather if price is moving, is price is always hunting for liquidity, looking for liquidity to sweep. Okay, so a liquidity grab is just a liquidity sweep, right? That quickly reverses, while a liquidity run is also a liquidity sweep that does not reverse but continues, right? So when we talk of liquidity, you guys say, this is just a liquidity sweep, it's just a liquidity sweep. What it means is, if it's a sweep is just the general name, right? When price takes out liquidity, right? But for you to identify it as a grab, it means price would just make a sweep and reverses, right? That's why liquidity grab is for reversal moves, while liquidity run is when price makes a sweep of a certain form of liquidity and continue moving in that direction, right? This one tends to be like a fake out. Price will rapidly or impulsively go to a target region, take out the liquidity, and just reverses to the opposite direction. And of course, we know that there are different forms of liquidity. We can have liquidity in form of equal highs or equal lows, or you can have even triple lows, right? You can have liquidity in form of resting, in form of trend lines. We've talked about that in the past when we talk about liquidity. You can have liquidity above swing highs and swing lows, or above previous daily highs, previous daily low, previous weekly highs, previous weekly lows. Those are where liquidity is always resting, and we differentiate the internal liquidity from external liquidity. You know about that one, that price moves from internal to external and external to internal. But when we're talking about runs or grab, we're talking about the liquidity that's usually resting above highs, right? Extreme highs and extreme lows, right? So it means for price to go higher, price takes out liquidity, a form of liquidity, and move up. So for example, say you have form of two equal highs resting here, right? Two from high liquidity, and price just takes this liquidity out and reverses real quick, right? So and this form is called a liquidity grab. It means price takes out the liquidity at a particular high, and all of a sudden, instead of continuous structure, it rather broke structure to the downside. You see a body close basically on the 4 hours time frame, right? The sweep or run can happen, the grab or run can happen on different time frames, or any time frame, right, that you are using to analyze, right? It can happen. It's just to know how to identify them and to know which time frame you want to actually follow. So price can do something like this, little pre-back and continue, right? Or you can have price having, they can be equal highs here, and price still goes ahead to take it out, right? To take that form of liquidity out, comes back down for a continuation move, and you catch. So in this form we call it a liquidity run, right? Because after grabbing a certain form of liquidity, price did not reverse. It rather broke structure to the upside or the downside depending on that particular trend, and continue moving in the specific direction. So liquidity grab, reversal moves, right? Liquidity run, a continuation move, right? I basically love I don't know, most times I love taking trades after a liquidity grab, right? Because it just gives you that sweet kind of move when price just takes out a certain liquidity and does not close above, then breaks structure to the downside. It's usually a good confluence, right? If you match it with other confluence, right? Not saying every time price does that, the trade must play out 100% of the time. No, right? Matching it with other confluence, maybe a high time frame key level that price has just tapped into and sweep to the downside. It gives you more confidence to take that trade, like so, especially after a liquidity grab, right? So if you hear people say liquidity sweep, sweep, it's just the sweep is just a general term, right? So, but to identify what happened is liquidity grab or run. So liquidity grab, I've explained, is a liquidity sweep, right? That reverses when market makes a liquidity sweep above a particular high or low and reverses instantly, right? While a run is a liquidity sweep also. After price takes out liquidity, it does not reverse, it continues, right? So you understand, if people see liquidity sweep, you try to understand which part of it is it, a grab or a run. Okay, so let's just go through this particular pair and let's see if we can identify a liquidity grab or run on any of these pair. Okay, good. There's one that happened here. So this is a 4-hour time frame, usually analysis time frame. So if this happens on the 4-hour time frame, it's a good area of confidence that you can take your price. But you can also identify those grabs or runs on lower time frames also, right? So you can see market here. We had market creating this upward movement, of course, upward movement. Then all of a sudden, market created a high, a low, then pulled up and this and swept this liquidity right here, right? So this high, this particular high, there's liquidity resting there, right? You can see price sweeping that highs and closing below. Immediately price took out the high, the 4-hour candle closed below, a new 4-hour candle continued, and we saw that kind of a shift right here. And you can see our price pull back. So at this pullback, that will be a good continuation move on lower time frame for you to catch a trade to the downside. You can see our market swept liquidity. So this is a good example for what liquidity grab. So market was in an uptrend on this range, then we have a sweep grabbing liquidity on this highs, then breaking structure below, then market continued going down. So this is a beautiful example. So at this point, if you go to lower time frame, you see good confluences for you to catch a trade. Imagine market dumping for 4, 8, 12, 16, 20 hours. That's a beautiful kind of trade. So you know that, oh, this particular liquidity, and we also have a concept of SMC we've also talked about, where we have a form of protected low or protected high. It means regions whereby price have made a form of liquidity grab, right? A form of liquidity grab. Price has swept liquidity, broke structure and shift. So it's a grab when we have market sweeping liquidity right below. Instead of continuing the structure to the lower region, price decide to go ahead and break structure just after sweeping liquidity. So this is a beautiful example of liquidity grab, and we call this kind of low, any point of interest here in SMC, we call it protected. Why? Because this low has already what grabbed liquidity, it has swept liquidity, so it is protected. So we can have a little bit of confidence to take trade or to wait for trade to mitigate the particular point of interest. Then we can get in for continuation. Why? We know that, oh, this low, except price is going to take multiple liquidity grabs, right? You can have market creating multiple liquidity. I think we've talked about that in the past, but for this, you see price sweeping a particular liquidity, closing above, so it's a grab, and immediately you can have an opportunity to mark that region as a protected region, right? It's a protected low or a protected high because it has taken out form of liquidity. This region is now protected. So if price pulls back to those regions for a trade, we are confident to take a trade off that POI for a continuation, right? So this is another importance of knowing how to spot them very properly, right? So you can see price actually give you an opportunity to buy from this particular POI. You see this 4-hour candle that took out this liquidity and shift structure to the downside. Price made a pullback to that region, right? If you use our Fibonacci, you see it's within the premium zone, and price sold directly to a stronger, higher time frame point of interest for price to continue the buys. Okay, so you must catch, not necessarily when I say it's for reversals. I know a lot of people could get confused when I say, oh, liquidity grab majorly happens when market wants to reverse. The reversal might not be a complete change in the state of structure of the particular trend, right? We had a reversal here on this particular range because market was going bullishly. Then there's a reversal after this sweep. Market grabbed the liquidity here, broke structure to the downside. So it's a reversal, but not generally reversing the whole entire structure, right? But on this particular range, price was going bullishly. We had a bearish move to the downside, which was just on the higher time frame structure, was just a pullback to a proper demand zone, or proper area of support or proper area of discount where price would continue buying. So it does not generally mean that, oh, whenever you see a liquidity grab, price wants to entirely change the structure of the market of that pair, right? That's not what I mean. So it can happen within a range, except you're using maybe high time frame like the monthly chart, the weekly chart. Then you can have price, then you target regions where price might be going to. So it can be in a bearish scenario, or it can also be in a bullish scenario, right? Which of any of them works, right? So but this is a beautiful example when we have of that run. No, this is grab, sorry, not run. So I'll give you an example of a run, right? When price takes out a certain form of liquidity and instead of reversing, right, it just continue moving, right? It just continue moving. For example, you have a little bit of trend line liquidity right here. Okay, you have a little bit of trend line liquidity right here. So if you look at this, right, so immediately price, okay, we can even identify this trend line from here. Yeah, you can even identify this trend line from here. Let me look that on the graph. Okay, beautiful. Right, okay, good. So if you look at this, immediately price took out this form of trend line, right? Trend line liquidity. So remember the example I gave you guys. So you can have liquidity in forms of trend line. The price may, if price wants to up, price may grab and reverse. You must have seen events like this, right? Where you have trend line liquidity, and all of a sudden price takes out this liquidity. Immediately price takes out the trend line. Then put out the trend line here. Immediately price takes out the trend line. A lot of people will be waiting for, so immediately price sweeps off the trend line liquidity, price can reverse aggressively. So in that form you have a liquidity grab scenario. But in the form where price takes out all the trend line liquidity and you just have a little bit of pullback and a continuation, so in this form you can call it a liquidity run. So after sweeping all the trend line liquidity, price did not reverse. So it can be in the form of trend line liquidity. This is a good example of a trend line liquidity scenario. It can be in the form of an equal highs. It's just for you to know the concept and how to use them, right? So on this form you see price just taking out this liquidity, and you can see continue the run, right? And immediately took it out. We saw a close above this previous low or previous high. I can use this one, I can use this one, but there was a beautiful close and price pulled back for a continuation move, taking out all the trend line liquidity, right? In some certain scenarios you might see price, because of course there's a sell supply zone here, right? Certain scenarios, right, this trend line liquidity may just act as an inducement for price to sell, right? You can have a scenario whereby price creating the form of trendline liquidity, then after price sweeps it, immediately price sweeps it, taps into a sell POI, then you see this, something like this can happen. Let me clean this chart. So you can have a form of trendline liquidity like this, a form of a sell point of interest. So all this trendline liquidity may be acting as an inducement, right? This high may be acting as a liquidity, right, for price to take out. Then you might have price move like this. After sweeping this liquidity, price can just take this high, tap into the sell zone, and we have that sell to the downside. So in this kind of scenario, what you have now is a grab. So price taking out all the trendline liquidity aggressively, taps into, after taking out the liquidity, instead of continue the structure, taps into a sell POI or a supply zone, and you will see an aggressive sell here. So you can have that playing out. But in this scenario, you see, even when price came and tapped into the sell POI, this sell order block right here, you can see what happened. There was a form of rejection, right? There was a form of rejection, but price continued moving. Even after taking all the trendline liquidity, there was no reversal. So at this point, you have a liquidity run. It means price sweeps liquidity, did not stop, continue taking out. So look at it, took out this, no reversal, took out this, no reversal, took out this, no reversal, took out this sell POI, also no reversal. So this is a clean example of what liquidity run. Price just keeps taking out liquidity and keeps going higher without even making a pullback, right? So you can see that all over, playing out all over again. So if you know how to identify them, you would be able to utilize any opportunity they present, right? You need to utilize any opportunity they present, right? So this is just what I wanted to drop today. Where is it? Okay, I cleared it out, right? So all I need you to do now is to backtest this, right, over and over. Of course, definitely a lot of people would have taken sell position from this place. Are they wrong? No, it's a beautiful sell setup, but where they might be wrong is to now go to a higher time frame to confirm the directional bias and how price has been moving bullishly. So if you know where price is coming from, you can see price was coming from this mid level of this POI. You see there was a break of the trend line, if you test on it, and aggressively price took out this region, right, shifting structure, and there was a beautiful run continuation. So a lot of people would have taken, aggressive traders would have been stopped out, but confirmation traders would wait for price to mitigate this sell POI. What will give them a confirmation that price is going down? Because this was the low that moved aggressively to mitigate this point of interest, and this is the only pullback we got. So confirmation traders would not have been stopped out. Why? They'll be waiting for price to at least take out this low, right? If price had moved from this region, took out this low with a body close, right, you enter at a pullback for a sell. You know that, oh, price mitigating a sell point of interest, broke structure that has created a market structure shift on your analysis time frame. You enter for a pullback, and you know that market will be going down, and what will happen would have been a liquidity sweep after taking out the trendline liquidity, tapped into a higher time frame point of interest, and sold. And you see, usually if this kind of move happen, the sell will be aggressive, right? There'll be an aggressive dump or aggressive buy. So usually after a liquidity grab, the reversal moves usually very fast, right? So that kind of trade, you enter, you hit TP very fast, usually very fast. After market taps, sweeps liquidity, grabs it, shifts structure to downside, you go enter for a pullback, it's usually very, very fast, right? So this is also a good kind of SMC setup, but confirmation traders would be good. So it will be good for you to wait for confirmation. So at this particular move, if you have watched this POI very well, you observe the reaction of the market, right? Say you did not catch the buys and markets mitigate, you can see, right? A lot of people that would have been stopped out, they'll be like, oh, these candlestick traders will be like, this is a clear evening star pattern showing blah blah blah, and all of a sudden the market takes them out. So it's better to wait for structural confirmation, which is let markets sell down and close below the previous low. That will give us a beautiful market structure shift. Then we can have confidence to say we want to take the sales, right? So always, especially if you're new, right, start out as a confirmation trader so that you know how to enter safe trades, right? Till you now master lots of the moves the market is making by experience, you now know how to take trade aggressively, right? So that'll be all for today, guys. Thank you for watching.